Hey everybody, welcome to this free edition of our Trader User Group or weekly roundup for the trading week ending June 24th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is another bull trap. Well, after this strong move higher this week, I know a lot of folks, you guys included, are wondering, is this going to be it? We finally made our lows for the year and then we're just off to the races, or is this just another trap? And it's going to roll over and make new lows. Well, let's kind of dig into that just a little bit. Before we do, let's take a look at the prior week. We'll just kind of see where everything is sitting. We'll look at the index performance. As I said, this was a very strong week. Everybody was up dramatically, over 5% for the Dow, over 6 for the S&P, over 7 for the Nasdaq. Russell coming in dead last, but still over 3% for the week. Year to date, still in the red. You can see Nasdaq and Russell still in a bear market. S&P moved out of a bear market just barely to about 18% underwater. The Dow is doing the best, a little over 13% year to date underwater. You can look at the PE ratios, and right now the current forward 12 months just slightly under 17. I still think it's a little bit high. It's probably going to have to come down a little bit more, but more on that later. The S&P dividend yield is coming in at 1.68%. Treasury is at 3.12. So the 10-year Treasury is still about 144 bips higher than the S&P. That's 1.44%. The earnings yield's coming in at almost 5.25% for the S&P, and that's about a little over 2% higher than the 10-year Treasury. But when you throw in inflation, it's still a negative 3.36%. Now I think inflation's going to come down just a little bit. Current VIX was down 12.5% for the week. It closed out the week at 27.23. The prior week it finished at 31.13. I was telling our members 30 is a key number. As long as the VIX can stay below 30, then we're going to get away from some of this really wild movement, although I imagine many of you probably saying it seems like every day it's a wild move in the market. But we're seeing signs that inflation's moderating just a little bit, but keep in mind the prior month's inflation took away the notion of peak inflation. Okay, April came in at 8.3%, and then May came in at I think 8.6%. So really a little bit of a notion that, hey, inflation has not peaked just yet. So are we at peak inflation? Hard to tell. We're going to have to wait and see. There's a lag in the market, so there's a lot of debate going on right now on just where the term structure is going to be for the Fed fund futures rate. But that's kind of what we're going on right now. You can see the best performer for the week was discretionary, although it is also the worst performer for the year. You can see the numbers. The worst performer for the week was energy, although it's the best performer for the year. So a little bit of bounce, and some of this can be dead cat bounce or energy just profit taking. We'll kind of see where that lines itself up, all right? What's really interesting is through June of this year, the three best sectors were energy up about 65%, utilities up 2%, materials it was down 5%. But those are the three best performing sectors through June of this year. And then from June through where we are right now, the three worst sectors were the three best sectors. Energy's down about 20%, utilities down 12%, materials down 14%. So what was the best performing sectors are now the worst just over the past 3 weeks. So we're seeing some bounces, some money being reallocated. And for all we know, it could be another bull trap. We have to pay very good, close attention to it. I've got a chart on that in just 1 minute, which I'll share with you guys, okay? But that's the index performance. Economic data, well, there's a lot of signs out there that this hard turn, more hawkish turn by the Feds is starting to have an effect on slowing the economy, moderating inflation. Home sales fell to their lowest level since May of 2020. We're seeing the Chicago Feds here in the U.S., which is a regional Fed, came out with their 8-month low in manufacturing activity, while the global index of June manufacturing came in well below forecast here in the U.S., still above 50, which indicates expansion, but very, very slow. Meanwhile, on Friday, I think we got the University of Michigan consumer sentiment. It was revised down to 50. It's the lowest level we've seen there going back 40 years. So we've got clearly the economy is slowing. Energy is coming down. We actually saw a downtick, a rare downtick in gasoline prices at the pump. Okay, still very, very high. But this could show that that concept of peak inflation is starting to moderate a little bit. But the real interesting thing, though, is analysts still haven't taken down their earnings per share estimates for the rest of this year. Some analysts have come out and said if we do have a recession, and the markets are looking at a mild recession, that's going to reduce earnings per share by 10 to 15%. Remember, there's about a 90-day to 120-day lag in the markets with what consumers are doing spending wise and what's reflected at the company level. But that would imply dropping the PE ratio. As you can see up there, the forward PE is 16.95. But if we drop it down to about 16 with a drop of 10 to 15% in earnings per share, suggests a low in the S&P to 3,200. Now, as you guys know, I reduced my range for the low down to 34 to 3,500. I had it sitting at 37 to 3,800 for about 2.5 or 3 months, but I've reduced it a little bit lower. I've been telling our members that through the end of this month, we will get a little bit of a bull trap kind of rally. And then when we kick off earnings in July, we get another CPI data print and we get the Feds coming in. I do believe we're going to roll back over again and make new lows. So I think you need to take advantage of this bull trap while it lasts. Okay. And then, of course, if we look at U.S. Treasuries and we look at Boom Boom Powell, he testified in front of Congress and the Senate this past Tuesday and Wednesday, basically saying inflation expectations appear to be anchored, which means in consumer speak, Fed speak, that means we've reached peak inflation. It's not going to go much higher. Of course, how many times have they said that before? He was a little bit hawkish in his comments, but what it did do is the Feds or the markets were pricing in a 75 basis point rate hike in about 3 weeks, 4 weeks when the Feds meet in July. But it reduced that percentage down to almost a 50-50 bet whether they do 50 basis point or 75 basis point. So if they do 50 basis point, it'll show the Feds believe peak inflation is hit. And while they're going to be very aggressive, not as aggressive as the markets have been forecasting, and that tends to make the markets a little bit more bullish, right? So that's kind of what I'm seeing right now here. But there are a lot of economic data points that are pointing to us already in a recession, a mild one, but still a recession nonetheless. I mean, we've seen a lot of commodity prices dropping off. We've seen copper fall 20% in the past 3 weeks. All right, just really ugly, ugly. And that's kind of where I am in this thing too. I do believe we could be in a mild recession or move into one. We're seeing the high yield market. They've doubled the yields in high yield up to 8.4% in like 3 or 4 weeks, just doubled the yields. And that would be like junk bonds in the corporate sector. And we've only seen a doubling like that just 2 other times. Once during the 08-09 great financial crisis here in the US, and then in the COVID lows in 2020 when they shut everything down. Outside of that, we hadn't had a doubling in that fast of a period of time. So these things create shocks in the market. And then whenever you create a shock, you tend to have a counter move and then things settle in again. So I believe through the end of June, we're going to get that counter move. And that's kind of what we're seeing right now. Of course, if we look over in Europe, you can see here just about everybody was in the green except for Germany. Euro stocks, FTSE, CAC 40, all in the green for the week. Year to date, everybody's still in the red. Okay. The DAX was the only index that is suffering a little bit. Now, Germany came out and said they're moving to their second quote unquote alarm stage of their emergency plans to reduce gas consumption and increase energy storage and storage of thermal fuel and things like that after Russia's kind of really sharply cutting the pipeline energy flow to a lot of European countries. And other countries are also joining the fray with Germany. So that's causing a little bit of action over there. In fact, Europe could probably already be in a recession because their economy is a lot worse than the U.S. We're getting flash indexes. Eurozone composite PMI fell down to 51.9 in June. That's just barely above expansion. Anything over 50 is expansion, below is contraction. So that's the lowest it's been since February of 21. Okay. Consumer confidence in the Eurozone also tumbled to a minus 23.6, which really means nothing except in the context that it's near the lows that it was at in COVID 2020 lows around March of 2020, I guess. So consumer confidence there and the U.S. are very poor. And being the contrarian red striped zebras that we are, that would mean we can expect a bounce. Everybody's very, very pessimistic. So that's why I'm also been telling our members to expect a bounce as we move through the end of June, which would be the end of Q2. It would also be a second moving into the second half of the year, end of the month. So we're getting a lot of things going on here with rebalancing and stuff like that in index funds and the Russell rebalancing. So that does tend to create a little bit more agita in the markets than normal. Okay. Meanwhile, over in Great Britain, their UK inflation accelerated to a 9.1%. That's even higher than us. We came in at 8.6 in May. They came in at 9.1. And that's the fastest rate they've seen in 13 years moving up. Their PMI data also fell to 15-month lows. They're barely above break even too at 53. So we're like teetering on the edge of contraction versus expansion, not only in Europe, but over here in the US as well. Okay. Now, if we look at the Asian markets, all of them are in the green for the week. Everybody's in the red for the year. Okay. Japan's CPI came in at 2.1. And that's the lowest of any G20 country. They're trying to get their inflation higher and higher, but it's not high enough. So they're still stimulating their economy. The Bank of Japan did say that it's still lower than they want to see it. So it's just, I find that very interesting, which is why the yen is totally cratered. They're going cross current from the U.S. So the yen is just totally flopped right now. Be very careful in trying to short that thing. I think it's going to make a good long run here, but I think that's only going to happen when we see them start to resume a less supportive stance stimulus-wise for their economy. Meanwhile, China hangs in, both of them in the green for the week. China, their markets advanced because President Xi basically pledged during their BRICS gathering, that would be Brazil and Russia and India, China and South Africa. They had the BRICS meeting. I think they did it via Zoom call. They all got together, but Xi basically pledged to roll out more economic stimulus to support the impact of their zero COVID policies, which is just totally ludicrous. But, what are you going to do? He's a dictator. You're not going to stop him. So that's going to wash ashore to Europe and the U.S. clearly, I think, over time, which is going to slow everybody down. Shipping, supply chains are screwed up probably through the end of this year. A lot of analysts have also lowered their growth forecast for China. Because you remember when we shut down in March of 2020 and we opened up, it really took 3 or 4 months just to fully get things open, and then things didn't work for a while. Well, China, this is the second shutdown. They were shut down most of March, April, going into May. And then in June, they started to open back up city by city. I think there was like 31 cities that pretty much locked down. Okay. That's going to disrupt their economic activity, screw up global supply chains for the remaining part of this year, as I said. Okay. Meanwhile, the property slump, which we talked about earlier this year, is still raising fears and could pose a longer-term risk to China's economy than this COVID lockdown, because that's just a temporary measure, and it's going to take them 6 months to probably work out of it. But the property issues could be a lot longer lasting, I believe. Okay. What I want to do is shift you over right now to I want to shift you guys over to the charts. And this chart that I put together for you, I just want to show you. Let me get it over here on the screen for you. This chart you need to take a look at, and just don't get too wrapped up in these big fast moves that we're seeing here. What I've done is I've taken the S&P E-mini futures from the beginning of the year when the S&P hit an all-time high of 4808.25, as you can see on the upper left-hand corner of the screen. And then every bull rally that went more than 3.5%, I just put it on the chart. I put the percentage move, the number of points, and it's not exact, but it's close enough, right? because I did it by just using my mouse and clicking on it. I could have put the exact numbers in, but it's, you guys get the picture. And then if you look in the upper right, we've had 7 rallies this year. The average move was 7.69%. Okay. The average number of days for the move is 6, and the average point move is 312 points. Right. So now I didn't count where we are right now, but if you look in the lower left hand side of the screen right down here, we're up 7.66% roughly, about 278 points. And we're in day 1, 2, 3. So we're in day 4. So keep in mind, we've moved 10.2% in this rally here. It was 391 points. This one right here, we moved up a whopping 12%. It was over 500 points. And every situation, as you can see, these yellow lines, it's the Donchian channel. We've just moved lower and lower and lower. Now, the width of this Donchian channel, which basically shows the lows over the previous 20 trading days and the high over the previous trading days. So you can see it's a lot wider now. It's about 15.5% from the bottom to the top of the Donchian channel. So it shows you this big sell-off right here that we had really starting in early June. Now, when you get a big sell-off like this, typically you move up 50% of the move, right? And if I just kind of blow this up, and let's just take a look at it for a second. You can see here, and I want to really zoom in on this thing. You can see here, we actually, and it's rare that this happened, but we had a gap down. We closed there, and then we opened down there in a rare gap down, right? So this gap was filled this past Friday, right? And now this dash line right here, you can see we went up and kissed it and closed near it right here. That represents 50% of the move from the previous 20-day look back high to the 20-day previous look back low. That is a fib number over this move lower, 50% retracement or an extension off the lows. That is a common pullback point. Another one is 61.8, and then another one's up over a little over 70%. So where are we going to go from here, and then how are we going to get there? I had positioned in, let me just get this, let me get this thing back here. Let me just get this off my screen so I can move it around a little bit and move my screen back to its normal setting here. So let's just get it back. So you can see right in this point right here that I do believe we can move up. And I had said 41 to 4,200. So the upper boundary of this Donchian channel, then we're going to run into trouble. And then I think it's going to give us a rollover again. If we do that, that would be a whopping 560 points roughly off of these lows here to the highs. And then we roll back over again. So I am still saying that we are in another higher probability bull trap move. That does not mean that we can't trade these to the upside. I was telling our members about 2 weeks ago that we're going to get another bull trap run. I mean, look at all these. They're fast runs. They only average, as I said, 6 days, and it moves 312 points. Okay, and if you just do the math and take 312 and divide it by the 6 trading days, that's 50 points a day. Now, obviously, some days you're moving 70 or 80 points, other days maybe 25 or 30. But we're moving fast either way. And it allowed us and our members to get positioned for an end of year rally. Okay, now it's still pretty choppy. You can see some of these things chopping, but I believe we're not done yet with this move. Now, if we look at another chart right here, you can see we came down and made new 2022 lows on June 17th. We were down 24.32%, okay, at 36.39. And then we actually started that little over 7% rally. There's the gap at 38.96. We filled it. Keep in mind the 50 EMA is sitting at 40.41. So that's why I'm saying 4,100 to 4,200, and then we're going to peter out. The first challenge is going to be the 50 EMA at 40.41, right? Remember, a lot of this is short squeezes too, because we've had the mother of all shorts sitting out in the market. So some of these bull rallies happen quickly and fast, and sometimes quite often because you get a lot of shorting activity in a bear market or a down market. This is a bear market chart because the 50 is below the 200. I do believe we still have more downside. Again, I said 34 to 3,500 is kind of the new range that we can expect through the end of June and July. I'm sorry, end of July going into August. And I think we'll have a rally through August into September. Then I think we'll have one final rollover before we get a finish into the year. And we'll probably finish down either flat to slightly negative for the year. If we get a recession, it's going to take us even further down to that 31, 3,200 area. But if it's a mild, fast recession, not sure if we're going to be able to get that low. But that's a little bit about what I'm seeing here. This is the E-minis. If we look at NASDAQ and just kind of see where that is, you can see NASDAQ hit a low on the 16th. We were down almost 34%. Notice the NASDAQ is a lot further away from the 50 EMA than the S&P. So, but either event, I'm looking at the 50 EMA as a potential resistance point for all of these trades here. We had a bullish divergence on NASDAQ, so that tells me that we finished in Elliott Wave 5. We'll have an ABC pattern, then we'll see where we want to go. Okay. If we come down here and look at, we'll look at the Russell, it's not performing as strong as, say, NASDAQ right now. You can see here, although it wasn't as low, we hit my second target down here a little bit early, but we hit it down 33.3%, right? And it was on June 16th that we hit the lows. And again, you can see the 50 EMAs providing overhead resistance. I would expect it again in the Russell sitting here around 1834. Okay. So that's a little bit about what I'm seeing here. And then, of course, in the VIX, I want to keep us below 30. We were able to get down below 30. This is the 30 level. You can see this 35, 36 area, we seem to run out of juice and move lower. The 50 is still over the 200. So that would be a bear market looking chart for volatility. All right. And it's been over the 200 EMA going back most of the year. And you can see all these moves higher. We run up to around the mid 30s and then we come back down, come up to 30s and we come back down. I don't think we're going to get much lower than the 24, 25 area until we get the settle of are we in a recession or not. Remember, as we get through the first month after the end of the second quarter, we're going to get the first pass of GDP for Q2. That's going to go a long way into saying are we in a recession or not. All right. We're seeing Q1 GDP came in at a minus 1.4%. We'll get the final tally this next month in July. But it'll be the final count, and then we're going to move into August where we get the first pass of Q2 GDP. So August is going to really tell us a lot on are we in a recession or are we close to a recession or what. Remember the Fed GDP, the Fed, Atlanta Fed, let me say it the right way. The Atlanta Fed came out with their GDP now number. They update it every week based on economic data, and they're forecasting Q2 GDP to come in at 0%. Now, they're always generally understated in their GDP numbers anyway. So that would suggest a low single digit or a low, 1% or 80 basis points or something like that for GDP for Q2. We'll see how that shapes itself up. Treasuries, we've made a killing in the bond market. You can see here bonds. I would expect by the end of the year, I think the bonds are going to hit and go over the 50 EMA. All right. And you're going to see interest rates come down. Interest rates here, this is the 10-year. You can see it moved up. My target was around 3.31. You can see it blew through it on just a couple of days. This is the daily chart, and then actually went up to almost 3.5%. And this is when the markets really got unsettled in the first and second week of June, and then it settled back down again. And you'll see it probably find support at the 50 EMA. But I do believe by the end of the year it'll be down because the markets, and you may be saying, why is the interest rate going down in the 10-year and the 30-year when the Feds are talking about raising rates? Well, understand the Fed rate right now is in the Fed funds futures rate is at 1.5 to 1.75%. All right. The 10-year here is at 3.1. Why is it higher? Because the market's always front run everything. So they're guesstimating that the final terminal endpoint for the Fed is not going to be as high as they think it is. The Feds believe that their terminal trajectory for the Fed fund futures by mid 23 is going to be 3.8%. The markets are anticipating by mid 23 it'll be 3.5 to 3.25%. So that's why these rates are higher than the Fed fund futures rate. But the markets believe the economy is going to slow down dramatically towards the end of this year into 2023. It's going to almost run flatline. So that's why you're seeing people go into debt, and when you buy debt, i.e. bonds, treasuries, things like that, it tends to drive interest rates lower. So that's kind of where we're sitting there in the treasury market, but we've made really good money going long interest rates, short bonds. Q4 of last year through the first part of this year, we've done very well in it. Currency-wise, well, the dollar index, it's reaching its peak, and it's just going to slowly flop around here until we see activity in the euro, yen, and pound. Weakness in yen is helping keep the dollar index higher. It looks like it's forming a bull flag, which would suggest we're going to get one more peak out of this thing, and then it's going to roll over. So I do want to play the euro to the upside, but just not yet. Okay, that's kind of what I'm looking at. And of course, if we look at the yen has just come undone. You can see the yen. You don't want to short it down here. It's constantly blowing through my target levels and then flopping around down here. Although if you do go long the yen, I would do it long term. But it's called a widow maker for a reason, right? The yen is just a very hard instrument to trade. And it has been since the Bank of Japan has just been putting all that stimulus into the market. It's almost like not a real market. The Japanese government's just so intrusive in their markets right now. They own about 60 or 70% of all bonds issued in Japan, and they own about 60% of all ETFs or 70% of all ETFs that are Japanese issued. So it's not really a true capital market with price discovery. It's whatever the Bank of Japan wants it to be. So playing in that market's a little bit difficult because if you wake up one morning, the Bank of Japan just decides to change some of their policy and buy or sell the yen or the dollar, you're going to see yourself killed if you're on the wrong side of that trade. So that's why it's called the widowmaker. And then, of course, if we come down here and we look at metals, if we look at gold, again, we have a way of trading gold for our members that's making us good money. But I do believe gold is eventually going to come down and hit my target of about 1760 over the next 30 to 40 days, right? Probably through July. Gold's just going to come right on down, okay? Same thing with silver, but notice gold, you got the 50 EMA over the 200 EMA, but they're about ready to cross. And if we look at silver, it's dramatically underperforming gold. It's near its 2022 low, but look at the 50 EMA. We had that crossover here back in April. Very rarely do you see, I mean, you generally see either gold lead silver or silver lead gold for a while or perhaps a year or two, but not in the opposite direction. So that's why I'm saying gold is probably going to catch up with silver and give it up a little bit more while silver is finding a bottom or a basing pattern down here for a longer term play to the upside, which I do believe is going to be an opportunity, just not yet. And of course, if we look at energy, oil is the top performer for the year, but they've given up, 17% in the week a week ago, and this week a little over 2 or 3%. I mean, just look at it; it's just come undone. I think oil will probably move up, test the 50 EMA, and kind of chop around here. Again, we got a way to trade oil. That's a pretty cool way where you can make money. But if you try and trade it directionally, you better be a day trader because it's very difficult to try and guess with all the macro forces impacting oil from the supply chain to Russia, Ukraine, energy requirements. Sippy Cup Joe's going over hat in hand or ass in hand to ask and beg for the Saudis to pump more oil, which to me is just totally stupid waste of time, but it is what it is. So that's what's going to happen over there. How it affects oil, I don't know, but we have a way of trading oil that makes money. I have been bullish oil. I've also been bullish nat gas. That was an easier low-hanging fruit trade. It's given it all up now, which I'd said it's probably going to come down and find support down around this area here. Nat gas has a hard time staying up this high. It's damn near impossible. But it's going to stay bid probably north of 5. Right, probably this is the second support area. I think it'll stay north of here for a while because soon as we get our port, Freeport, had a nat gas terminal where they put the LNG and ship it to Europe. It caught on fire. It was only supposed to be out of commission for 3 or 4 days. It looks like it's going to be over a month or month and a half. All that natural gas that was going to Europe is now staying in the U.S., so that gives us an overabundant supply, which we always have with nat gas. So that's going to drive the price down a little bit until that port comes back open and they start shipping that nat gas back over to Europe again. So that's just, it's a very, natural gas is a very choppy, very choppy, very erratic commodity to trade. So you just have to be careful with nat gas, how you play it. Okay. That's a little bit about where we're sitting here. I've got some other trades in the commodity markets our members are doing that's working out very nicely. So hopefully you guys are having a great weekend this weekend. As a reminder, next weekend is going to be another long holiday weekend for U.S. markets because on Monday is our Independence Day. So I will not be doing a weekly roundup that weekend. I'm going to enjoy the time off. Otherwise, everybody have a great weekend. Members, I will see you tomorrow night for our weekly market watch. If you are not a member, I highly encourage you to come in. We like playing all these markets, especially the commodities when you have imbalances like we're seeing. Have a great weekend, everybody. Ciao now.